Hi everyone, in this chapter, we're continuing with chapter 9 this week, inventory's additional issues. And the main thing that we're going to focus on in this chapter is the measurement, evaluation of inventory. As you are working in your project in QuickBooks as well, you're going to see when you purchase your inventory, you're making a purchase. You're making an investment into a piece of inventory and then you're going to sell it, right? So the idea is, what do you value the inventory? How does the inventory get valued on the balance sheet? Of course, when the inventory gets sold, which is what you're seeing in your file, when you sell an inventory, you credit the inventory on the balance sheet, so it's off the balance sheet. You debit that same amount into cost of goods sold, and it becomes an expense on the income statement. However, the inventory that hasn't been sold yet, stays on the balance sheet at a value. And that's exactly what we're talking about here. We're talking about what is the unsold inventory being valued at on the balance sheet, right? And this is called lower of cost or net realizable value. Basically, it is whatever is low. Basically, if your inventory has been written down and it's no longer worth what you paid for it, you have to reduce the value of the inventory. How much do you have to reduce it by? By whatever is net realizable value is estimated selling price minus cost of completion, disposable, or transportation. Essentially, what you're selling it for if those costs are immaterial. So it's just basically estimated selling price. And if that is lower than cost, you have to write down by however much that new selling price is lower than cost. So let's look at some example. The Collins Company has 5 inventory items on hand at the end of the year. The year-end cost is determined by applying FIFO cost method, and the net realizable value, current selling price less cost of completion, disposal, and transportation for each of the following items printed below. Items A and B are a collection of similar items, and items C, D, and E are another collection of similar items. Each collection can be considered a category of inventory. So let's see here. Item A, you have a cost of 50,000. NRV is 85. So clearly the NRV is higher than cost. So we're going to have 50,000 as the what we're going to have the cost at. And item B is cost is 100,000, but the realizable value, so the selling price had gone down, so you're gonna have 90. Okay, so by category, okay, total A and B is gonna be 150. Okay, for now. Now, okay, now C, we go into C and we have cost of 80,000, NRV of 75, so we go with the lower, 75. D, we go with 85, the lower. And E, we go again with the lower, is the 95, and we have 256. Okay, because all those are lower cost of market, as opposed to with the initial one, we're not going with 140 because the B item, the A item was actually at cost, still listed at cost. So we're adding them up as if they were at cost still, and then total again, we add up the total inventory value at that